Imagine this. It's 1711. Britain is stuck in a war and drowning in debt. Enter the South Sea Company, a new trading venture. Their big plan? To make money trading with Spanish America. They take on the government's debt and, in return, get a monopoly. This monopoly gives them exclusive rights to trade in the South Seas. And the big prize? Access to the gold and silver of the New World. Back then, this seemed like a win-win for both the government and the company. England in the early 1700s was all about financial experiments. The War of the Spanish Succession had really drained the treasury, so they were looking for new ways to handle debt. The South Sea Company, with its promise of riches from trade, seemed like the perfect solution. Investors, dreaming of big profits, jumped on board. Little did they know, this was just the start of a wild speculative frenzy. So, the buzz about the South Sea Company's potential spread like wildfire. Everyone was speculating, buying assets, just hoping to sell them at a higher price. Investors, driven by all the rumors and hype, pushed the company's stock price through the roof. Starting at £128 in January 1720, South Sea Company stock just skyrocketed. By June, it had hit an unbelievable high of over £1,000 per share. But here's the kicker. This meteoric rise wasn't backed by actual trade profits. The South Sea Company's trading operations were pretty minimal. The real driver was pure speculation. People bought shares simply because they thought others would pay even more. This speculative frenzy created a self-fulfilling prophecy. As more people jumped in, the price kept climbing, and the mania just kept growing. So back in 1720, things were getting pretty wild. The bubble hit its peak and then boom, it burst, causing chaos everywhere. In June, the South Sea Company got worried about how fast their stock was climbing, so they convinced Parliament to pass something called the Bubble Act. This act was supposed to stop people from going crazy with speculation by limiting new companies. But guess what? It backfired. Instead of calming things down, it made everyone lose confidence in the market. And to make matters worse, the directors of the South Sea Company, who were also caught up in the frenzy, started selling their own shares. This freaked out the regular investors. They all rushed to sell their stocks, and the prices dropped like a rock. By September, the stock price had crashed to below £200, wiping out fortunes and leaving countless investors in financial ruin. Let's talk about what happened after the South Sea bubble burst, and how it rocked investors and the economy. When the South Sea bubble popped, it sent shockwaves all over England. People from all walks of life, whether small-time investors or wealthy aristocrats, were left devastated. The crash really highlighted the dangers of unchecked speculation and market manipulation. Trust in the financial system was shattered, and the economy took a nosedive into stagnation. The South Sea bubble also stirred up a lot of political drama. The government got a ton of flack for its role in inflating the bubble and not regulating the market. The scandal brought down several big-name politicians and really hurt the Whig government's reputation. The crash was a harsh lesson on the dangers of financial excess and the importance of solid economic policies. The South Sea bubble, though centuries past, remains a cautionary tale. It highlights the timeless dangers of speculative bubbles. These occur when asset prices become detached from their underlying value. The bubble's rapid inflation and subsequent burst serve as a stark reminder that irrational exuberance in the markets can have dire consequences. The crash underscores the importance of financial literacy and regulation. Investors must be aware of the risks associated with speculation. Governments and regulatory bodies play a crucial role in preventing market manipulation and ensuring market stability. The South Sea bubble, a dramatic episode in financial history, continues to offer valuable lessons for investors, policymakers, and anyone seeking to understand the complexities of the financial world. If you like the video, like, share, and subscribe.